This week's podcast episode is brought to you by Insuring Income. Insuring Income is your source for all things term life insurance and own occupation disability insurance. Insuring Income has a relationship with America's top-rated term life insurance and disability insurance companies so that pharmacists like you can easily find the best solutions for your personal situation. To better serve you, Insuring Income reviews all applicable carriers in the marketplace for your desired coverage, supports clients in all 50 states, and makes sure all of your questions get answered along the way. To get quotes and apply for term, life, or disability insurance, see sample contracts from disability carriers, or learn more about these topics, visit insuringIncome.com/your financial pharmacist. Again, that's insuringIncome.com/your financial pharmacist.
If we rewind to 12 months ago when everything started to go down and we were starting to see, job loss and things like that, you're like, whoa, okay, this is why we have that emergency fund.
You're listening to the Your Financial Pharmacist podcast, a show all about inspiring you, the pharmacy professional, on your path towards achieving financial freedom. Hi, I'm Tim Albrick, and on this week's episode, Tim Baker and I break down the key points of the most recent $1.9 trillion stimulus package, also known as the American Rescue Plan Act of 2021. We discuss the items that we think are most relevant to your financial situation and plan, including the stimulus payments, the expansion of the child tax credit, the unemployment compensation and benefits, and what to make of the student loan forgiveness provisions being tax-free through the end of December 2025. Before we jump into today's episode, I want to invite you to a free webinar on April 14th at 8:30 Eastern, where I will discuss student loan strategies for 2021. We all know that the federal administrative forbearance is set to expire at the end of September 2021, making now the perfect time to determine the best way to tackle your student loans. During this webinar, I'll share how to decide whether you should be paying on your federal student loans during the administrative forbearance, how to evaluate the many loan repayment strategies available, and what steps you need to take to pick the best repayment plan for your personal situation. Plus, if you attend the webinar live, you'll be entered for a chance to win a copy of the Pharmacist Guide to Conquering Student Loans, authored by Tim Church. To register for the webinar, head on over to yourfinancialpharmacist.com/strategy. Again, that's yourfinancialpharmacist.com/strategy. Tim Baker, glad to have you on the show. How's everything going?
It's busy. Tax season is upon us. So it's been really busy, but good. How about you, Tim?
Good. Speaking of taxes, we're going to come back to that topic today as we dig into the American Rescue Plan Act of 2021, also known as the most recent stimulus bill. And this, of course, as our listeners already know, is the follow-up to the CARES Act from March 2020, and then the Consolidated Appropriations Act that was passed in late December of 2020. So the primary focus of these bills, of course, have been related to COVID-19 relief. But as we will discuss, there certainly are some broader implications here that we need to consider. And while this bill contains lots of things, many of which we're not going to touch on today, we're going to hit on those parts that we feel like are most relevant to the financial plan of the YFP community and to those that are listening. So Tim Baker, I'm going to put you on the hot seat here to try to break down hundreds of pages of bills. And as we talk about what does all of this actually mean? So give us a 10,000 foot view. What is the American Rescue Plan Act? And really, what are some of the key pieces that the bill focuses on?
Yeah, when I see the numbers, Tim, I actually, I think they look like, or it reminds me of like professional sports like contracts. When you first saw that that $100 million contract, and now they're signing ones that are $250 million. That's kind of what it reminds me of. So the American Rescue Plan Act of 2021 was signed into law on March 11, 2021. It's a 1.9 trillion with a T piece of legislation that, according to the Department of Treasury, will change the course of the pandemic and deliver immediate and direct relief to families and workers impacted by the COVID-19 crisis through no fault of their own. So this has been billed, pun intended, as one of the most progressive pieces of legislation in our history. And I think what Congress and what the president is seeing is that, there've been, I think the number is like 9.5 million workers that have lost their jobs, and 4 million have been out, longer than a half a year or longer. So what this is really meant to do is kind of stimulate and help those that are, they're in need. So to your point, there's lots of things that this covers. One being things like infrastructure, which we're not even going to get into, but help with small businesses and vaccinations and testing and things like that. But I think what we want to do here is really kind of distill it down to what does this mean for many of the listeners that are tuned into this, and how does this affect me? And I think that's what we're excited to kind of dig in and jump in and talk through.
Yeah, and to that point, Tim, we're going to cover three main areas: economic impact payments, also known as the stimulus payments, the child tax credit, which I think is really substantial, and some of the changes that are forthcoming there that I think will have an impact for many pharmacists listening and their families, and then also some that may have been impacted in terms of jobs and unemployment compensation. So those are the three areas that we're going to focus on. Again, certainly not all encompassing of what this piece of legislation includes, but the three that we feel like are most relevant to you. So Tim, let's start with the stimulus payments, as these have already started going out, probably at the time of publishing. For those that are eligible, it likely has already hit their bank account. But how much are people getting? What are the phase outs here in terms of adjusted gross income? And what's different about this round of stimulus payments?
Yeah, so stimulus payments or recovery rebates, whatever you want to call them, this is really, to your point, Tim, round three. So the first one with the CARES Act was, a lot of people received, or the tax filer received $1,200 and $500 for dependents, and dependents was more strictly defined. And then second round, I think it was, something around $600 per person or per is what they were looking at. This is the most generous. It's the greatest stimulus. It's $1,400 per person. Think of it as a taxpayer, a spouse. But then it's also $1,400 for dependent. So a dependent is not strictly defined. This is not just anyone under 17. This could be a college age 21-year-old, somebody that you actually provide for the health and welfare. But it could also be for an elderly parent. So that was one of the big things that prior bills had really kind of left out in the cold, was those, those parents that were caring for elderly parents. And now all of that is included. So it is a greater benefit in terms of total dollars. It is a better definition in terms of like what it qualifies as a dependent. But the big thing that changes are the phase outs. So, and I wouldn't even really call them phase outs. They're more like cliffs. So for the phase outs for this round, and this is going to be based on either your 2019 or 2020 tax return. So for a lot of people, and we're seeing this on the tax side, it might be beneficial to you to kind of hold filing your taxes or not. And this is one of the areas that's going to be a big part of this. So for a single income or single tax filer, income below $75,000 in adjusted gross income, you're going to get that full $1,400 times, a spouse and dependents, et cetera. So if you're a single parent and you have a dependent, you're going to get $2,800. Now, the phase out, or more likely a cliff, is very narrow. So once you get to that 85,000, so 75 to 85,000, then basically that rebate or that stimulus check is gone. For married filing jointly, the number is 150,000, and then it completely phases out at 160,000. So before, these phase outs were greater. Now they're more like a cliff. So the idea here is, this is where planning can be very important here, because when we're actually seeing this, I mentioned like tax season is upon us. Whereas we're talking through clients, we're saying, hey, this return is ready to be filed, but we're just holding on to it until the stimulus gets figured out, and then we would go ahead and file the 2020 the tax return. And it's just basically a planning decision to get the most benefit for that client as we're looking at those situations.
Tim, I suspect we have many folks listening that, that cliff, as you put it, which is really one of the main things that's different here, in addition to the amount of these payments, are going to be impacted because of that cliff. So if I'm someone who's listening and 2019 and 2020, let's say I was just above married filing jointly, let's say for the sake of example, two dependents. So, if I were under that 150, it would have been $5,600 if I'm doing my math correctly. Let's say someone's just above that 160. Out of luck, it is what it is. Like what's the strategy, if any, here for folks that are just above that cliff and that threshold of those payments?
A lot of and we weren't sure about this until recently, but with the extensions of the tax filing date, a lot of the targets or the accounts that you can also put money into, like an HSA, like an IRA, have also been extended. So it might be where, you shift your strategy, or you're saying, hey, like I was really focused on this debt, i.e. student loans, that we know that are, $0 payments with the CARES Act until later this year. Maybe, you're trying to get ahead of that, but maybe you do shift some money into some of these other types of accounts to lower your AGI. Specifically, the HSA was probably the one, because there's no income limits. So these are things that you could do before you file. That and it's a little bit of circular logic, because sometimes you have to get all those numbers in before you can actually figure it out. Which again is helpful when you're having someone help you file your returns. So there can be some planning that you can do before you actually file, but there's also a look ahead. So the bill basically affords people that potentially have a lower 2021 tax year, so this year, that when they go to file in 2022, get a true up or a credit to their taxes, like say in the future. So basically, the way that this was explained to me is that if you have your 2019 or 2020 return and you're in that phase out within that range, you'll get a payout, and that's typically direct deposit with whatever bank account that you have on. Which, make sure you do that. So just a message out there: make sure your banking information is correct. We've had some that was incorrect, and that can take a long time to unwind. But the second checkpoint is if your 2020 AGI is less than 2019 and you filed before, so say you already filed your taxes, there's what's called the additional payout determination date, APDD, that you could potentially, the IRS could potentially look at it and true you up if 2020 is lower than 2019. And then looking ahead to 2021, if the AGI is less than that upper threshold, the IRS will send additional balance adjustments. So there are going to be some kind of fallbacks to make sure that the people that are in need of relief, that are in and around these AGIs, are going to be made whole. But there could potentially be some planning to get that money sooner.
Great summary. And I think what you just mentioned there highlights to me the importance of the planning, not only on the financial plan side, of course, which we have been adamant about promoting the value of and what our planning team does, but also on the tax side. I mean, for that reason right there, if you look at someone who may be in this situation, what's ahead for 2021, what could be done from a planning tax perspective with these numbers in mind as they look ahead to the year. So for folks that are interested in that service and working with our tax professional, working with our financial planning team, you can head on over to yfpplanning.com and schedule a discovery call.
And I would just say as a note to this, like this could be really where you are, if you have any control over of things like bonuses or unpaid leave and things like this, the planning, I think, is potentially associated with this. If you have a young family and you could potentially take FMLA or things like that, these are real life things that, it might not be worth you making that additional money to actually spend that time at home with your family. And that's the impact of this is if you do a little bit of planning, you can get a really greater benefit that's really even outside of the numbers of just the dollars and cents. So it's almost like being paid to stay home in some way.
So Tim, you mentioned a good PR campaign for the IRS. Make sure you have direct deposit set up. Make sure all that's good.
Yeah.
But if someone's listening, they think they should have received a payment and they haven't yet gotten one. What's the strategy here?
Yeah, just like anything tax related, I put the heaviest weight on the irs.gov. So if you go to www.irs.gov/coronavirus/get-my-payment. And we can put this in the notes of the, you should be able to see kind of the status and what that looks like. So the IRS, and you could probably just Google IRS stimulus check and you'll get this link, and that basically will direct you in what you need to do.
Tim, the other thing that comes to mind here is, if I'm listening today, I've received perhaps a previous stimulus payment in round 1 or 2 that maybe I've put in a savings account, is still sitting around, or it might have been added to here in round 3. I think it's a good time to think about what are some considerations in the event of an unexpected windfall. So, of course, assuming someone doesn't have a short-term need for these dollars, gap of employment, some type of other need. How do you think through this in terms of, okay, there's dollars here now that perhaps weren't planning on seeing those dollars, and the options of how somebody can best allocate those dollars to their financial plan?
Yeah, so I'm a big proponent of assigning kind of a purpose for like inflows.
Mm-hmm.
So, like with our business, Tim, like we get profit distributions from the business. Like I have a set purpose of that. And it changes from time to time, but I know before the money comes in, like what's that for? So, for a lot of us, and again, if we rewind to 12 months ago when everything started to go down and we were starting to see, job loss and things like that, you're like, whoa, okay, this is why we have that emergency fund.
Mm-hmm.
And for a lot of people, that can be tough to swallow, especially because where interest rates are right now. You're not being rewarded as a saver. You're more rewarded as a borrower for anything just because rates are so low. So, to me, it's really getting comfortable with, okay, if there was a catastrophic loss, like me or my spouse can't work and we don't necessarily have the means to generate income quickly, just making sure that is on point. The emergency fund is really important, but it can be a little bit of a double-edged sword because sometimes we have people that come and work with us and they have $120,000 in the bank, and you're thinking like, oh, that's that's a good problem to have, and it is, but it's a problem nonetheless. So to me, it's really about, once you feel comfortable with those cash reserves, is then getting that money into the market. Now, right now, one of the things that was not included in this, there was no RMD component to the bill. So what you're thinking like, okay, what's an RMD? An RMD is required minimum distribution. So once you get to a certain age, and I think they've recently changed this, but it was 70 and a half. But once you get to a certain age, the IRS is like, hey, Tim Albrecht, remember all that money you squirreled away in your 401k and you haven't paid any taxes on it? Well, now we're requiring you to distribute some of that to yourself that you pay taxes on.
Mm-hmm.
So they didn't put up anything in the bill with this. And because to be honest, those types of people are not really in need. It's like, okay, you have all this money squirreled away and you don't need it to live. Like there's no reason for a stimulus or some support there. So to me, it's really about, getting the money into the market in a way so that that could be an HSA, that could be an IRA, that could be a brokerage account.
Mm-hmm.
And because of the way that rates are, it's getting invested, or it could be actually looking at something that is more, life planning related. So I've had clients, recently that are, pulling money from potential retirement accounts to do something for their family, which is like a vacation home, a cabin in the woods, that, they're asking me like, is this crazy? And I'm like, well, no, not really, because again, this is a use asset that you're going to be able to rent out. You're going to be able to enjoy it with your family. You're kind of trading one asset for another, and we're doing it in a way that kind of minimizes the penalty and the impact. But things like that is like getting creative. And one of the things that you could do, Tim, is you could just stick this money into a checking account, and it really does nothing for you. It doesn't enhance anything about your life or your future plan, and that can be problematic as well.
And I think this is a timely topic, Tim. I'm thinking of folks that not only have received a windfall through like a stimulus, but also I'm assuming many listening are still in this time period where they're in an administrative forbearance on their student loans. So dollars that were otherwise being put towards debt, that maybe they're not making those payments, obviously individual to everyone's situation. Here, there's also additional dollars. And I think this really highlights to me the benefit of, you have a plan in place, you've been intentional, you think about the goals. And when that windfall happens, or when something happens, like you don't have to make, student loan payments, you're able to quickly identify and direct where those dollars are going to go because you've already established the goals and the plan to support those goals.
Yeah, and I think it goes back to the planning of, in a lot of ways, planning can start with us putting out fires, so to speak, but then it can really evolve to challenging the client to think outside of what is normal, is what is expected. And case in point is like, everyone thinks that like, a lot of people think like, oh, I have to work until I'm like 60 or 65. I'm like, well, do you? And again, this is potentially, something that we want to challenge clients on and say like, okay, we have resources that are here that we can, direct in a way that, again, you feel that you're living a wealthy life both today, but then in the future. And I think challenging, going from that, scarcity mindset to more of an abundance mindset, and challenging the client to push their plan in a new direction, I think is important too.
So let's shift gears to the child tax credit. I think this one has made a significant splash as a part of this bill. Somewhat I guess, difficult just to understand exactly what is changing, what's going to be different, who qualifies, who doesn't. But I suspect many listening are going to be interested in watching this unfold to understand how this impacts them and their personal situation. So, child tax credit, tell us a little bit more, Tim, about what's included in the American Rescue Plan as it relates to the expansion of the existing child tax credit that we have.
Yeah, this actually was a tax credit that was expanded in the Tax Cut and Jobs Act under the Trump administration. So, back in the day, it was, you had a child and it was $1,000 credit. Now, before we used to get exemptions on the tax return, and those have gone away. But one of the things that the Tax Cut and Jobs Act did is that it changed the credit. It doubled it from $1,000 to $2,000. And then it really expanded the phase outs.
Mm-hmm.
So at a baseline today, if you have a child, you get a tax credit of $2,000, and that doesn't phase out until $200,000 for a single taxpayer,
Mm-hmm.
and doesn't phase out until $400,000 for a married filing jointly. So it's already a lot more generous. And then with this extra temporary provision as part of the American Rescue Plan, it actually increases more. So the credit amount has been increased. So it goes from $2,000 to $3,600 for children under age of 6, and that's by the end of the tax year. So I think Olivia turned 7 this year, so I'm going to be over that. But then it does go to $3,000 for other children under the age of 18 by the end of the year. The example here would be if you have 3 kids, 2 years old, 4 years old, and 8 years old. Previously, that would have been a flat $6,000 credit. So $2,000 times each kid. So $2,000, $2,000, $2,000 would be the $6,000 credit. Now the credit would actually be $10,200. So you get the full credit for your 2-year-old, $3,600, the full credit for your 4-year-old, which would be $3,600, and then $3,000 for your 8-year-old because you're above the 6-year-old threshold. So that would be a total of $10,200. So for those of you that have lots of kids, Tim Albrecht, this could potentially be a big benefit. So the other big part of this is that the scope has been expanded. So children 17 years old and younger, as opposed to 16 years old, and so it gives you an extra year. Now, the other things it does is it follows the same phase outs as the recovery rebate, as the stimulus check. So again, from a rebate perspective and from a child tax perspective, for married filing jointly, that 150 to 160 is critical. And finally, the one big thing that it does, and then I want to go through the kind of the advanced payments really quick, but it's now fully refundable. So non-refundable tax credits, Tim, basically what that would mean is, let's pretend at the end of the day, you have a $10,000 tax bill, but then you have $10,000 of fully refundable. So that would basically, it would zero out your tax bill.
Mm-hmm.
If you had $12,000 of a refundable tax credit, you would actually get $2,000 back. But if you had $12,000 of a non-refundable tax credit, it would just zero it out.
Mm-hmm.
So for the IRS, the tax credits are the most generous in terms of credit versus deduction, but a fully refundable credit is even better because that actually sends money your way versus like zeroing out your balance. So that's really important.
Tim, to rewind to make sure I understood correctly, and correct me if I'm wrong. So they are looking at, when we talk about the phase outs, they're looking at 2020 income in terms of AGI?
It's going to be whatever's on file. So it's going to be,
okay.
Yeah. So again, this is one of the things where if your 2020 income was higher than 2019,
mm-hmm.
Especially if it's within that threshold, if you're filing your taxes and that, that disqualifies you, you want to make sure that you put a pin in that and not file.
Mm-hmm.
And that's just a little bit of planning. Now, if it has gone down because of the pandemic, and say, you made 180 as a family, and this year you're going to be making, 145, 150, then absolutely get that tax return filed and get the benefit of both the stimulus checks, but also the child tax credit.
Gotcha. And if I understand correctly, before we go on to the advance payments and how these are going to be distributed, or at least what we think they will be as of now, the phase outs from so you mentioned that $200,000, $400,000 on the existing tax credit of $2,000. And then you mentioned the phase outs of income here that also mirror what we saw in the stimulus payments. That is for the bonus amount, correct? So from what is going to 2 to 3 or 2 to 3,600?
Yeah, that's right. So you have the baseline amount that's what's part of the Tax Cuts and Jobs Act. And then, this would be it's called the extra temporary,
Okay.
benefit. So yeah, that's right.
And so for those that are listening, like I was when I read this, like, my goodness, just tell me what the number is, please.
I know.
So there's a good calculator I found on Kiplinger.com. We'll link to in the show notes where you can enter in AGI, kids that are under 6, kids that are above 6, and it'll project out what that payment will be. But of course, again, I think, working with somebody and thinking about some of the strategy side of this can be really helpful as well. So Tim, how will this be paid out? Talk to us about the advanced payments of credit and ultimately at least what the IRS is thinking right now. Although to be fair to the IRS, they're also in the midst of tax season. Of course, we have an extension to that as well. So I think there's going to be further guidance coming in this area. But what at this point are we expecting?
Yes, this is kind of like a nuance with this particular part of the bill is that this is actually going to be paid out almost like a stimulus check versus like a credit, which you typically don't see with with this type of legislation. So you'll likely get half of the credit paid out in monthly checks beginning in July. And I think I might have said it was based on the 19, but it actually might be based on 2020 regardless, because the payout's going to start in 20 or in the summer. So this might be where it is tacked onto the 2020 versus 19. But another example, your AGI is under the 150. You have a child under the age of 6.
Mm-hmm.
The total child tax credit would be $3,600, and you would get basically $300. So $300 per month, or $1,800, basically between July and December. So the idea is they want to try to get more money into people's hands. And then the rest of that, the other $1,800, would be when you file your 2021 taxes. So now if you look at the benefit when you stack it up, in other years, that $2,000 credit, which we would just get basically at tax time, it goes from $2,000 to $3,600, and then they divide up. Half of it is coming to you in check form between July and December, and the other half, at tax time.
Mm-hmm.
That's the big thing. And again, this is going to be, to clarify from what I said before, this is going to be for 2020, your 2020 taxes, and then basically pay out the rest of the year, and then the credit or the true-up would be in 2021 when you file your 2020 taxes. So clear as mud.
And as I understand it, there's going to be a portal where folks can enter in information, update it. So somebody that says, hey, Tim and Tim, we're having a baby in 2021, they'll be able to update that information. Or if payments go out without updated information, that then essentially there'd be a true up when they go to complete that 2021 return.
That's correct. Yeah, the idea is that at the end of it, if you file in subsequent years and you're in the following year, that what the IRS or what the government's trying to do is make sure that you get those dollars that you wouldn't have otherwise because of So from a behavioral perspective, it's going to be interesting because, again, before this was all just kind of figured out in the wash at tax time, but now you're going to see people starting to receive checks throughout the course of the year, which is, again, a little bit different than what we're typically used to outside of these bills that come around when the economy starts to tank.
And I think the other thing, Tim, here that's interesting, and certainly we'll keep the audience up to date, but for folks that are watching this as well, is nothing has been decided yet. But my understanding is there are some policymakers that are considering, is this expanded credit something that should become permanent? And so, obviously that has implications beyond what we're talking about here, but could be significant to many folks in terms of what that means for their financial plan. So that's the child tax credit, as you said, clear as mud. So the last piece we want to briefly touch on is unemployment compensation. So we obviously know some of the challenges you referenced early on, Tim, in terms of some of the job loss. We suspect that some listening in terms of their pharmacy positions may have or are currently facing a situation of unemployment or a spouse or significant other. So I think this is noteworthy. What do we see in the American Rescue Plan Act as it relates to the unemployment compensation?
Yeah, so the good part about this is that it's been extended. So one of the big headlines in and around before they signed this bill to law and they were going back and forth between the House and the Senate was that, hey, these unemployment benefits were expiring. So typically, that's the beauty of deadlines, right? So the pandemic unemployment assistance, these benefits were set to expire March 14th. They've been extended until September 6th. So if you fall under that bucket, you'll have a few more months of relief. And then the other big thing that is important to note that the federal pandemic emergency unemployment piece. This is the additional check amounts. So you have the state benefits. So the state will pay you, $500 a week, for unemployment. But then what the federal government did is they added another $300 per week. So this has also been extended, which is important because there's some states that the way they calculate their unemployment, it's tough to live off of or survive. So these are the big things. And then the other thing that happened is that the first $10,200 of unemployment is tax free. So what this means is that per person. So if I'm unemployed, the first $10,200 of unemployment compensation received in 2020 will be tax free. So the AGI must be under 150,000 AGI. So that's the number that you keep seeing. And this is all filing statuses. So it doesn't matter if you're single or married, filing jointly. And this is a true cliff. So if you make $150,000 and $1 and you had unemployment, that unemployment will be taxed. If it's just under that, then that will be tax free. So this is a true cliff. There's no phase out whatsoever. So again, if you did file for unemployment and you receive compensation, this will be another thing to take a look at to make sure that you're under that, because that could be thousands of dollars in terms of your tax liability.
Tim, the last piece I wanted to ask you about, it certainly did not make as much of a splash in the news as did the stimulus components, the tax credits, or the unemployment compensation. But there was some news that came out related to a loan forgiveness that I suspect some of our listeners are trying to figure out what does this mean, if anything, for my own personal loan situation. So specifically related to what we often talk about, non-public service loan forgiveness and the tax-free component. Tell us about the change here as it relates to loan forgiveness and what we saw in the American Rescue Plan Act.
Yeah, so the big question that a lot of people are saying is like, what's the loan forgiveness in the bill? And there really wasn't much in there. And I think a lot of people think that this could be potentially a precursor to what President Biden wants to do in his tax bill. But the big thing that did come out is that it does include a discharge of student debt as taxable income for both federal and private loans. But this debt discharge has to occur between the years 2021 and 2025. So as most people know with PSLF, if I am in that program and I do my 120 payments over, 10 years and I have $60,000 that's forgiven because of that program, that $60,000 is not viewed as taxable income. But if I'm in a non-PSLF forgiveness option and I do that for 20 or 25 years, that $60,000 is then reported as taxable income in the year of forgiveness. So if I make $100,000 and that year I get, $60,000 forgiven, it's if I earned $160,000 that year. So this is one of the things that they added. Now, for a lot of the non-PSLF forgiveness strategies, some of these won't even become due until like later in this decade. So it doesn't really move the needle much.
Yep.
I think what this is really trying to address are, you get excited, or I get excited sometimes when I see like, oh, there was student debt forgiven, but it was a lot of these like for-profit schools that kind of misled borrowers and things. I think it's really trying to address those people that have been forgiven, which are a very, very small percentage of people out there that through legislation, that they've been forgiven and they're not going to be taxed as if they receive that income. So very, very, very minimal in terms of what came out for the student loan borrower. Now, President Biden has indicated a willingness to kind of do something here with student loans. I've had people that I've talked to, prospective clients are saying, hey, I'm just trying to figure out what he's going to do. I think what President Biden wants to do is have some type of bipartisan legislation and not use the executive order. I know Democrats are calling anywhere from, they want 30 to 50,000. I mean, you have some that are saying the whole, all of it, but typically more moderate Democrats are saying 30 to 50,000. President Biden, I think, has expressed a willingness to potentially use the executive order to do $10,000 per borrower. But who knows, Tim? You
don't have a direct line to Biden. I mean, what's the problem?
I don't. I mean, he is an Eagles fan, as I am, being from Delaware originally. So we got that going. But nope, I don't have the direct line to Biden, unfortunately.
So am I understanding this correctly, Tim, that this is in part potentially setting up tax-free forgiveness if something were to move in that area. So if this window of time, 20 up through end of 2025, so let's fast forward 6 months, 12 months, 18 months, whatever, whether it's legislatively or through executive order, there's some forgiveness that is granted. Let's just say, for sake of conversation, it's a $10,000 forgiveness as an executive order. This is in part setting it up that $10,000 would then be tax-free forgiveness.
Yeah, I think that's what they're doing. Again, a lot of what's in this bill, I think, is planting seeds for what could potentially come in the Biden tax bill, which could be, very much a needle mover. So I think so. I mean, I think that, a lot of borrowers are really, they come to me and they say, like, Tim, I don't want to look at the forgiveness option because I don't trust it, blah, blah, blah. And I get that. But again, especially when you look at the PSLF and you look at the math, like, it's really hard to look at the numbers and say, yeah, let's not at least consider that. The reason I'm bringing this up is that I think because of all of the rhetoric around student loans and how it can be suffocating to someone. And, we've talked about studies that people getting married later, buying houses later, starting their families later, all of those things. I think it could potentially be breadcrumbs potentially to look at a forgiveness that's similar to PSLF, even for for working in the private sector, but not necessarily the same timeline, but the same tax, the tax, where it is tax free or not. It could, it could be, I could be completely off the mark there. I guess what I'm saying is that I think that the student loan, like the borrower, where we're at today, it'll be more generous to them in the future, not less. So a lot of people are saying, like, oh, well, tax could PSLF go away. And I'm like, it could, but I don't think so. Like, if I'm looking at that, I'm thinking as a borrower, it'll be more generous, because I think it's just something that the screams are going to get louder and louder. And, in terms of like, hey, the system is not working. Where the price of schools are and things like that, it's not working. So we need to, have some forgiveness. I mean, if you look at $1.9 trillion, that would do a whole lot in the student loan department, because I think it's 1.6, 1.7 now. So yeah, great stuff. And I think we have covered a lot, Tim. And I think for our visual learners that are saying, hey, that's great information, but I need to see some of the numbers for myself, read through this, understand it in a little bit more detail. We're going to link in the show notes to the treasury.gov information. We'll also link to the Kiplinger calculator that I mentioned earlier when we discuss the child tax credits. And our hope is that you'll be able to understand and apply that information in your personal situation. And of course, we're here and ready to work with you for those that are looking for a financial planner to be in their corner, as well as to have a tax professional working alongside of them. So before we sign off for the day, I want to invite you again to a free webinar that we're going to be doing on April 14th at 8:30 Eastern. We're going to be talking about student loan strategies for 2021. So as we've discussed here, briefly, we all know that administrative forbearance is set to expire at the end of September 2021, really making now the perfect time to determine the best way to tackle your student loans. So during this webinar, I'm going to share how to decide whether you should be paying on your federal student loans during the administrative forbearance, how to evaluate the loan repayment strategies that are out there, and what steps you need to take to pick the best repayment plan for your personal situation. So to register for the webinar, you can head on over to yourfinancialpharmacist.com/strategy. Again, yourfinancialpharmacist.com/strategy. Have a great rest of your day. Before we wrap up today's episode of the Your Financial Pharmacist podcast, I would like to again thank this week's sponsor, Insuring Income. If you are in the market to add own occupation disability insurance, term life insurance, or both, Insuring Income would love to be your resource. Insuring Income has relationships with all of the high-quality disability insurance and life insurance carriers that you should be considering, and can help you design coverage to best protect you and your family. So head on over to insuringincome.com/your financial pharmacist, or click on their logo or link in the show notes to request quotes, ask a question, or start down your own path of learning more about this necessary protection.